This tax season, you're standing at a literal crossroads. You have to make a choice between two entirely different financial paths, and doing nothing is actually a choice in itself. The Ministry of Finance has officially made the new tax regime under Section 115 BAC the automatic default for everyone. If you just let the deadline pass without actively picking an option, the system automatically enrolls you into this new structure. The immediate upside is significant. By combining the standard deduction with the current tax date, a salary of 12.75 lakhs results in a tax liability of exactly zero. But there is a massive catch. To give you that zero tax threshold, this default system intentionally wipes out over 70 legacy tax exemptions that you've likely relied on for years. Blindly accepting the default without running your own numbers could mean leaving tens of thousands of rupees on the table. Worse, it could quietly derail the long-term saving strategy you've already built. The old regime operates on a specific philosophy. It rewards you for locking up your capital. It pushes you into forced savings, long-term investments, and heavy structural commitments like mortgages. The new regime flips that entirely. It prioritizes maximum upfront liquidity with zero administrative friction. You keep more cash in your pocket today, no receipts or proof of investment required. Look at this chart. It breaks down a hypothetical 15 lakh rupee salary. Under the new regime's low rate calculation, you pay a modest, predictable tax directly off the top line. Now watch what happens under the old regime. If we stack traditional deductions onto that exact same salary, like ADC investments and health insurance, the taxable income drops rapidly, often down to zero. This makes the decision much bigger than a math problem. You are choosing a lifestyle. Do you want cash in hand today to spend as you please? Or are you willing to maintain a highly managed, tightly restricted tax shelter? Let's look at the first common taxpayer archetype. We'll call them the simplifier. This is someone earning a gross salary up to 12.75 lakhs. For them, the math is straightforward. The 75,000 rupees standard deduction combined with the Section 87A rebate works together to drop their final tax bill to absolute zero, no investments required. Then we have the opposing archetype, the optimizer. This person is actively paying off a home loan and deliberately maxing out their investment limits every year. This table compares salary tiers against a break-even deduction threshold. By combining home loan interest, HRA, and ADC, the optimizer reduces taxable income by up to 5 lakhs. To justify the old regime, deductions must cross this exact number, otherwise it costs you money. But the optimizer path comes with a hidden cost. The immense burden of strict cash flow allocation. Your money is locked away, and you have to meticulously track every receipt and premium. If you lack heavy structural expenses like a mortgage or high rent, forcing yourself into the old regime just to claim a few deductions is an incredibly inefficient use of both your capital and your time. We also have to account for edge cases, starting with the executive, individuals earning an ultra-high income over 5 crore rupees. For them, the new regime offers a massive mathematical advantage by capping surcharges at 25%. The old regime's aggressive 37% surcharge makes it practically obsolete at this income level. Then there's the proprietor. If you are a freelancer or business owner filing complex corporate returns, you fall under an entirely different set of rules. This brings in a document called Form 10 IEA, which imposes a strict legal lock-in rule on your business. Salaried employees can switch regimes yearly, but business owners can typically only opt back into the new regime once in a lifetime. You are permanently bound. Senior citizens also face a unique hurdle. If you rely heavily on interest income, you must carefully weigh the exact cost of losing the Section 80 TTB deduction under the new rules. For these specific edge cases, standard internet tax advice completely fails. The sheer weight of those surcharges, or the permanence of Form 10 IEA, dictates your choice entirely. We can boil all of this down to one guiding rule. The higher your salary goes above 15 lakhs, the more massive your deductions need to be to justify staying in the old regime. To help you map your exact profile, we've built this visual scorecard. It plots the 4 main taxpayer archetypes we just covered. If you want maximum upfront liquidity and earn under 12.75 lakhs, you belong in the simplifier quadrant. The new regime is your clear default. If you are actively paying a mortgage and maxing out your ADC limits, you sit in the optimizer quadrant. You need to run the exact math, but the old regime will likely save you money. If you're a high earner or business owner, you must factor in those restrictive surcharges and lifetime lock-ins before you file. Locating your exact quadrant cuts straight through the noise. It gives you a mathematically sound baseline for your decision without having to pay for a consultation. The government intentionally made the new regime the default to simplify the national tax code at scale. But while the government wants simplicity across the board, your personal financial reality might demand complexity to protect your wealth. Just be careful not to let the tax tail wag the financial dog. Do not purchase a mediocre insurance policy or take on a massive home loan strictly to generate a tax break. The most effective tax strategy is one that aligns with the life you're building, rather than one that prioritizes a lower tax bill over your actual financial health.